Hey everyone, welcome back once again to our CA Foundation Business Economics series where we are discussing economic concepts in the most practical manner. So, without wasting much time, let's get back to the video. So, today we are covering chapter 7 Public Finance, in which we will cover unit 4 Fiscal Policy in this video. So, here is the introduction. Fiscal policy refers to the government's use of taxation, public expenditure, and borrowings to influence a nation's economy. It plays a vital role in achieving economic goals like maintaining full employment, ensuring price stability, promoting economic growth, and ensuring equitable distribution of income. So, fiscal policies are classified into expansionary and contractionary types depending on the government's approach to stimulating or cooling down the economy. So, here are the objectives of fiscal policy. The primary objectives of fiscal policy are full employment, price stability, economic growth, and income and wealth distribution. So, first, full employment, ensuring that all available labor resources are being utilized effectively. Second, price stability, controlling inflation and deflation to maintain a price stability. Third, economic growth, so encouraging the overall development of the economy by stimulating productive investments. And fourth, income and wealth redistribution, so reducing economic inequalities by promoting social welfare programs and using progressive taxation. So what is progressive taxation? Simply, progressive taxation means you will be taxed higher and higher as soon as you start earning more and more. So if you are earning less, you will be taxed at a lesser rate, and if you are earning higher, then you will be charged at a higher rate. So suppose if you are earning more than 10 lakhs, so you will be charged at 30% compared to one who is earning say 7 to 8 lakhs, he will be charged at 20%. I am just discussing the old taxation rates. The example for income and wealth distribution is the Mahatma Gandhi National Rural Employment Guarantees Act, which aims to provide employment and improve rural infrastructures, thus achieving the objective of full employment while also addressing poverty. So the both objectives are achieved. If you give employment, so they will be earning some income, so they will be out of poverty. Then comes types of fiscal policy. First, expansionary fiscal policy. It is implemented during periods of economic recession to increase aggregate demand. It includes first, reducing taxes, that is leaving more disposable income in the hands of consumer. So if you will have a lower tax, suppose currently if you are earning 100 rupees, the tax is 30 rupees. If you reduce the tax to 25, the amount which you will having in your hand, that is disposable income, will be more. So in earlier case it would be say 70, but if you reduce the tax from 30 to 25, you will be getting 100 minus 25, say 75 in hands, that you will be spending on more other goods and services. Then comes increasing government spending, that is on public works and services like infra, education and healthcare. Example, during the COVID-19 pandemic, the Indian government increased healthcare spending and offered tax relief measures to boost the demand. Then comes contractionary fiscal policy. So it is used to curb inflation by reducing the money supply in the economy. It involves increasing taxes like reducing disposable income to slow down consumer spending, decreasing government spending, that is cutting down on unnecessary public expenditure. So it is exactly opposite of what we discussed earlier. Example, in the 1980s, to reduce inflationary pressure, the Indian government raised taxes and reduced public spending. Then how the government does it? So we have instruments of fiscal policy. First, government expenditure. So public expenditures on projects like road construction and infrastructure creates employment, generates income and stimulates demand. During inflation, the government can reduce spending to control aggregate demand. Example, The construction of highways under the Bharatmala project generates job and stimulates demand of construction material. Second, taxes as an instrument. So taxes affect the disposable income of individuals and profit for businesses, as I discussed earlier. So reducing taxes increased disposable income, while raising taxes curtails spending and slows inflation. Example: lowering GST rates on essential goods during inflation will boost consumer spending. Third, public debt as an instrument. So governments borrow from domestic as well as foreign sources to fund projects or cover the deficits. So borrowing can curb private investment, that is crowding out effect, but it is essential for financing long-term projects. Example: the issuance of government bonds like the National Savings Certificate (NSC) provides funds from for infrastructure development funds. Then comes public budget as an instrument. So a balanced budget implies no net impact on aggregate demand, whereas a budget deficit increases demand by borrowing, while a budget surplus reduces demand by curbing expenditures. Then, fiscal policy for long-term economic growth. So, fiscal policy focuses on building infrastructure, education, and healthcare, improves productivity, and support long-term economic growth. So, the government spending on human capital formation makes workers more productive and boosts the overall economic performance. Then comes fiscal policy for reducing income inequalities. So governments use progressive taxation and public spending to reduce inequalities. Higher income earners pay a greater proportion of their income in taxes, and the revenue is used for social programs like subsidized housing, healthcare, and education. Example: India's PM Kishan scheme provides financial support to farmers, targeting the lower income group and promoting equity. Then comes limitation of fiscal policy. So there are some pros and there are some cons. So we are discussing limitations or cons. First, time lags. So implementing fiscal policies really take times. By the time policies are enacted, the economic situation might be changed. Second, crowding out. So government borrowing can raise interest rate, reducing private investment. Third, political constraint. So short-term political goals often interfere with the long-term economic plan. And fourth, deficit financing. So continuous borrowing to fund a deficit leads to rise in public debt, which is unsustainable. Example: crowding out effect. If the government borrows, say, rupees 50,000 crores and the interest rate may rise from 6% to interest. So the increase in interest rate discourage private firms from borrowing, thus reducing private investment by 20,000 crores. Now we are at the end of this chapter, where we have MG extras. So in this video, MG extra, or the activity which will help you to learn these concepts more practically, is visit or analyze the local government spending. Research the local government in your nearby area and the infrastructure project that they have done, and analyze its effect on employment and aggregate demand. So how it is impacting. Then comes to the conclusion of this video, that is, fiscal policy is a powerful tool for managing a nation's economic health. By carefully manipulating taxes, government spendings, and borrowings, government can influence economic levels, inflation, and economic growth. However, policymakers need to be mindful of the timing and limitations of fiscal policy to avoid unintended consequences like crowding out private investments or exacerbating public debt. So that's it in the video. Thank you. Bye bye. Keep learning, keep growing, and keep enjoying.